We're with Petr Poldauf, a Senior Investment Director of Private Equity Secondaries at Schroders Capital. So Petr, tell us a little bit about the Private Equity Secondaries strategy at Schroders. What is this strategy about?
Yeah, so our strategy for secondaries has developed as the secondaries market has developed. The main innovation on the secondaries market, so-called GP-led transactions or continuation vehicles that started to emerge already 10 years ago, but really accelerated after the outbreak of COVID-19. And roughly 50% of the secondaries market is now GP-led. Last year was a record year for secondaries, more than $150 billion of volume transacted globally, and GP-leds were half of that, so more than 70 billion. So it's already a very big market that is growing at the double-digit rate, and it's very attractive tool, liquidity tool, that is attractive not only for existing LPs, but also for the managers and also for the buyers. And we believe that especially the GP-led market is poised for very strong growth. And with that, we made a deliberate decision already 5 years ago to focus on this part of the market, on the GP-led transactions.
And why do you think, or what do you think will be driving this growth?
Number of factors. One is the general need for liquidity. There is a lot of private equity that is growing quite strongly, but the exits do not seem to keep up. By exits, I mean exits to another private equity funds or strategics or even IPOs. IPOs are generally declining as percentage of exits for private equity. So there is generally need for new tool for GPs to monetize their investments. And we believe that certain type of assets are really well suited for those GP-leds, those situations where the GPs want to hold on to their high quality assets. They don't want to sell the assets too early to give up the upside potential. So some companies in the portfolios of managers are really well suited for GP-leds, and we believe that in the future, more than 10% of all private equity exits could be GP-leds, which would basically mean that the volumes could still double or triple from where they are today.
Wonderful. And what about, is there any specific characteristic of private equity secondaries growth and outlook for the emerging Europe region?
The secondaries market follows pretty closely the overall private equity market. So with the growth of private equity, also the secondaries market growth, you can basically say that certain percentage of private equity assets is basically turned around in the secondaries market. So if the PE market is growing, then is the secondaries market as well. The liquidity is generally much needed. Private equity, as everyone knows, is very illiquid asset class. So if there is a tool that brings liquidity to the market, gives investors an option to step out if they want to or if they need to, that in the end also fuels the private equity market. So it's kind of a flywheel effect. And so we see this not only in the US and Western Europe, but also in the Eastern Europe, that it's basically growing everywhere. But having said that, obviously CE is still a small market for PE and is somewhat catching up, but the trends are, I would say, the same as in Western part of the world.
And what about VC secondaries? Because that's also that market that's growing, not a segment that's growing a lot. It's something that Schroders does, right? Or started doing, as we mentioned earlier in our conversation. So what's happening there?
So on the venture side, you have the venture LP secondaries market, which is relatively small. It's, I believe, roughly 10% of the overall secondaries market, of the LP market. But the much bigger part of secondaries on the venture side are direct secondaries. Those are situations where ex-employees or founders of the venture companies want to sell, but that's a different approach because it's more concentrated strategy. It's about picking particular companies instead of investing in well-diversified portfolios. But you have both. You have buyers for both, but there is typically some specialization that there are different buyers for the direct secondaries in venture and different buyers for the LP positions in venture funds.
And what about the challenges in finding the right secondaries deals in private equity, going back to private equity, which is your field?
I wouldn't say that there are kind of challenges in finding deals. The demand or I would say the supply of secondaries is really strong. So the private equity secondaries market is undercapitalized. So in simple words, there is, limited amount of money basically chasing a big pond and a lot of opportunities. So the buyers can be still very selective. So I wouldn't say that there are really challenges in that respect. You could think of obviously quality of the assets that can be a challenge. Sometimes you see kind of lower quality, but the secondaries market is very flexible. So the discounting compensate for quality. So if there is willingness from the seller side to do a deal, then there is kind of high chance that balance will be found and a deal can be made, right? Even for, let's say, mixed quality assets.
And how is this balance, when you're looking for a deal between discount rate and quality of the asset? How do you do the exercise?
It's obviously tricky, and we prefer to focus on higher quality assets that do not require such high discounts. There are investors that like to do those type of situations with kind of steep discounts and more, let's say, complicated portfolios. And then the general approach is that the lower quality assets in a portfolio are typically priced at steep discount to account for the risk, and then lower discount is applied on the higher quality assets, and you create a blend. But secondary investors are typically very conservative, risk averse. So if they see a lot of risk in a portfolio, then they will definitely price it in. And if there is a right of potential for one or more companies, then the buyers would put very minimal price or even zero when they do their offers.
Wonderful. And finally, when it comes to secondary investments, when you talk about ESG data collection, right? You do, I guess Schroders has a really strong strategy on this matter. And is there any, because in general, at least when you buy a secondary asset, you know what you're buying, as we were mentioning before, right? So is this also good in terms of being able to report everything related to ESG data? Do you think you can at least do better due diligence on this matter?
Generally speaking, the bigger portfolio, the larger portfolio you are buying as a secondary buyer, the harder it is to be close to the underlying companies and to data collection and so on. So as I mentioned before, we focus on GP-led transactions. Mm-hmm. Those are situations that in a lot of cases involve a single company that is being transferred or sold from the fund to an SPV or 2 or 3 companies. And then that allows us to do a deep due diligence on those assets. And obviously ESG is part of that. Our own secondaries fund is SFDR Article 8 fund, and it wouldn't be possible to do Article 8 secondaries fund with a strategy focused on diversified LP portfolio. So the fact that we focus on single assets or concentrated multi-assets allows us to really cherry pick assets that we want to own, that we are also proud of owning, and where we also get comfort on all ESG requirements.
Wonderful. Well, thank you very much